Welcome to the latest episode of KapVista Klips. Today we're joined by Lara and Tim from PLP or Private Liquidity Partners. How are you?
Doing well. Thanks, Daniel.
Well, thank you.
It's great to have you. So I want to jump straight into it. I want to understand who you are, what's your background, and how you got to this point. So I'll pass it over to you. You've got a really interesting background, and we want to hear all about it.
So I've been a venture capitalist, a technology operating executive, and a capital allocator. Unusually for a general partner in funds, I've been a limited partner. And as a venture capitalist, I've done what they call general partner-led secondaries. And my first fund, I also direct secondaries into companies really came into being in a big way with Facebook's secondary offerings, which I actually participated in long before it went public, and have done secondaries helped some of my companies do secondaries. Back in my first fund, there was a prominent founder in one of our companies that was getting divorced and needed liquidity. And in my, which is a common theme in some cases. And then in my current fund, we've helped some founders do secondaries as part of later transactions as a way to get liquidity. So I've been on sort of all sides of venture and tech operating for a long time. I've lived and worked in Silicon Valley for 30 years, which makes me experienced, maybe is the word I'm looking for.
Yeah. Highly experienced and connected.
Yeah, both. Yes.
Great. So I'm Tim Converse, and I've primarily been a technologist in Silicon Valley for the last 20 years or so, trained in math and computer science, but my focus has really been leading AI teams or machine learning teams for the last 20 years or so. I've worked for companies large and small, larger ones like Yahoo, eBay, LinkedIn, Microsoft, and most recently Adobe, where I was leading the applied science team working on generative imaging. Some of that work's coming out as Adobe Firefly now. And also at a number of startups. I've gone through the acquisition cycle 4 times. I wrote an early web programming book. And also that's sort of been, the machine learning work has sort of been my day job. And my night job was as an investor in startup ventures. So I've invested in about 45 companies since 2011. And so this, as we'll get into, this work marries my interest in data and AI and modeling with my interest in startups and startup investing.
Awesome. So what is the opportunity? What has driven you or led you to start PLP?
So as most people know, stock options vest over 4 years, and that worked really well in the 1980s when companies took 6 years to go public, still worked well in the 1990s when companies took 7 years to go public. And it's worked a lot less well in, say, the last few years when it's taken companies 15 years to go public. There is something engineers call an impedance mismatch. 15 years is a really long time to be illiquid in a company because employees, founders, early investors want to buy a house, want to send a kid to college, want to diversify from their largest piece of their net worth. Sometimes people get divorced or they get fired from a job. And unfortunately, a way a lot of the companies work is once you lose your job, you have 90 days in which to exercise and the clock starts ticking. And then even if you exercise, then you also then have to figure out how much you're going to pay the IRS for your alternative minimum tax. And so there are lots of reasons why people need liquidity. So secondaries has been a broad market historically around people buying and selling whole portfolios, which isn't what we do. We're doing one company at a time. Mm-hmm. And it's actually one of the last pieces of the venture capital market that's inefficient because these deals are harder to do because it is one company at a time. It doesn't support $1 billion fund. It's a sort of niche business. We like inefficient markets because people tend to make money in inefficient markets. Where markets are efficient, you tend to arbitrage away any excess profit. But at the same time, you're providing a real service for people who need liquidity.
Yeah. That's interesting because, having been in this space for quite a while, secondaries is or how early stage investors and founders or employees exit and make money is the question. Dealing with investors and they say, great, I like the technology, but how am I going to see a return? And that's always the issue. So it is a niche, but it is a point that there's a lot of demand.
Definitely.
Yeah, there's a need.
And it's a way, and from our perspective, what we're doing, you can think about it as de-risked venture, because you still get the sexiness of these names and companies that are growing, but we're doing it at a time that's Series C or later. So this isn't like, hey, we think we might have product market fit. This is long after that's the case. And our edge, which Tim can talk about, is that we have a data science first approach.
Yeah, so particularly because we're interested in companies that might, where the value might be realized relatively soon, as opposed to early stage venture, we've built a platform to do predictions on privately held companies. So we ingest a lot of data from various data sources, PitchBook, Crunchbase, web crawls. And from that, we have historical data and current data to build machine learning models to predict the likelihood that a company will IPO, the likelihood that a company will be acquired, the likelihood that it will have a step up in value due to funding. And essentially what we use that for is to produce a shopping list for the more human intensive activities of valuation and determining where we can get shares and so on. So it's the AI and machine learning platform that I've built provide sort of a funnel, start with 3,000 companies in this general area of late stage software and rank them by their likelihood of something interesting happening soon, come out the other end with 50 companies that we begin to look at much more closely. So that's kind of the data science premise of the company. And we use a lot more data than the 3,000. We train on databases of 80,000 companies or more to do the predictors, but we're ranking this smaller set of companies that are sort of in our sweet spot.
Brilliant. So walk me through some of the portfolio, some of the companies that you've looked at and how you came to that decision.
Sure.
Yeah, so so when we started looking at companies, so we didn't even have a website yet. We hadn't even updated our LinkedIn, but through word of mouth, somebody approached us. FTX, as you know, went bankrupt, but they had a stake in Anthropic. And so they said, people were like, hey, there's FTX stake in Anthropic available. Do you want to be, we weren't doing weren't launching SPVs yet, but we could have done Anthropic at a much lower price than it's out for today. We were offered X.com really early. OpenAI at a much earlier time, Scale AI, which is definitely a woulda, coulda, shoulda, because Tim had great insights into the AI data labeling space, given his background, that we were very excited about. And then we started pulling SPVs together, and we were approached by founder who said, I'm getting divorced. I have to write my wife a check for $3 million. And we started doing some SPVs. Tim and I invested in Perplexity together in December. We're up quite a bit in Perplexity since we invested, and then we invested with other people. We did an SPV in Perplexity early this year at a discount to the last round. We felt that Perplexity was undervalued. We did a bunch of work. A bunch of people on our team have search expertise. We've invested in search. Tim's worked in search more than all the iconic companies in search. And we had good insights into how search companies are valued, and felt that Perplexity was undervalued relative to OpenAI on a per subscriber basis. That's been holding true and rather nicely. And right now we're looking at some things that are AI infrastructure related, because we actually think that's a nice way to play Gen AI without paying as much of a premium to the Anthropic and OpenAI kind of names.
I should also add that that we realized as we started to do SPVs preparatory to the fund, that to do an SPV you really have to get investors interested in the particular name, which in turn means that really needs to be a name where there's name recognition. So this is the SpaceX's and Databricks and Stripes of the world. And our position when we're doing a fund is very different in that we may be investing in companies that are not at the top of everyone's mind, or and we see benefit in that because the very top of the list of decacorn companies that everyone knows, that's becoming a more efficient market that is traded on secondaries platforms, and it's more transparent. There's price discovery and so on. But instead, if you think of the top 200 unicorns rather than the top 10 decacorns, that's where we see a lot of the opportunity. And when we're running a fund, we have the discretion to invest in both names that people have heard of and names that people haven't.
Yeah.
And that's really important because something like 50% of secondary volume is SpaceX, Anthropic, what have you. And there are some really great companies, as Tim points out, that are on that list. For example, there's a rank list he did in September of a company that was 8 on his list. And it was a unicorn, but definitely outside of Silicon Valley, you've never heard of it even. And I was really excited about the company, and actually the managing partner at one of their lead investors is a friend. And I called him like, hey, do you guys want to sell? Anybody at the company want to sell? Because he had told us, if any of our companies end up on your list, tell us, because we don't like secondaries players, but we like you guys and we trust you. And he's like, yeah, nobody's really interested in selling. Well, a few months later, it becomes clear why. They got an offer from IBM for $1.8 billion. Literally 4 months later. I'm sorry that they were not interested in selling, but it's interesting because the list is working. It's nice to get that validation, that we are finding things that aren't on everybody's lips that are starting to exit.
Yeah. So the data, the data model works. Your
right.
top 10, top 50 list is actually, there's validation in it. So from a investment perspective, it's validation that your model is working.
Right. And also part of doing this kind of data work, right, is doing testing with historical data, back testing and so on, where you do exactly at a particular point in time what you would be doing now and show that this is predictive over a long period of time, so that it's very important to make sure in this kind of work that you're not fooling yourself. And so you have to be very careful about validating all the work.
Yeah. So I guess in this market, there would be a lot of opportunities to look at, and you have to be, very specific and use that data wisely to make the right decisions, because there's a lot of really good companies. Well, there's a lot of good companies out there that seem like they're good. I mean, you don't know, but the ones that everybody recognizes are the heavily traded ones. But there's so many
Exactly. Right.
Undervalued or overlooked companies that provide really good value.
That's right. Yeah, absolutely.
Yeah. Awesome. So in terms of the fund, what does it look like going forward? Because you're raising a fund at the moment, and you've made a few investments. So what does that look like going forward?
Yeah, so we're continuing to use some SPVs as we go along. As I said, we're working on a couple now, and we're continuing, Tim's continuing to do a bunch of the data work. We're continuing to source investments. And, when we source an investment, as I said, we look at Tim's list. We also figure out, do we know people? As Tim said on the SPVs, those do look different sometimes than things we might do as a fund, because when we do an SPV, we have to have an investor who wants to come in. And one deal we tried to do last year was so frustrating. We had negotiated a great price on a SaaS deal. It was a unicorn. It was profitable. And basically people were like, do you have any SpaceX available? Like, this looks interesting. It's like, what a colossal waste of time.
Yeah.
Like, negotiate a 40% discount on a company that's profitable and that's a unicorn and whatever else. Like, oh my God. But our process, one of the things that we should also describe is our process when we're doing diligence on these companies, depending on how it comes to us and what's available, we like to interview. We obviously are interviewing, selling shareholders. So whether that's an investor or early employee, and we've created really extensive, which is available as part of our data room, diligence questions, because Tim's run engineering teams, I've run corp dev and product teams, and other people have run on our team have run sales teams. And so we cover the sort of universe of functional areas. And so we try to get a good sense of the operating health of a business. And there are things that are obvious, like what's your net revenue, and what's your retention, what's your churn. And then there are things that are less obvious, like, for example, have you hired a chief talent officer? Because companies that have hired a chief talent officer are about to go through hypergrowth, for example. So there are sort of leading and indicators that aren't obvious unless you've actually been in one of these companies or around them for a long time. And we track those. We also are going to continue to interview people who are selling over time, because as a secondary fund without information rights, that is a way for us to monitor the health of a company. So that's useful for people to understand. It's not like we set it and forget it, because a lot of times the company, if our view of a company has changed, because that does happen in Silicon Valley, most of the time, if a company finds out you have their stock, they're pretty happy to buy it back from you because they don't like having a distributed cap table.
Yeah. Yeah.
So we've gotten some family offices in the US to invest. We're in discussions with a couple of asset management funds who are we're pretty deep diligence. And so we're continuing the fundraising and investing process while we fundraise. So that's where we sort of are.
Okay. And then in terms of deal flow, is it just the North America that you're looking at? What's the mandate, or where would you look for deals?
We mostly care about where the seller is. If we're doing a lot of what we do are obviously non-recourse loans to buy stock options. And if you're doing that, they really have to be US or Canada, mostly because if somebody disappears to Cyprus, that's a problem.
Yeah.
So that's where we're primarily focused right now for that reason. Although we did, an executive at Aura contacted us through the website. Although it's a EU company, the executive was based in the US. So.
Okay. Yeah. Okay. And that's on that's the companies, and on the seller side, obviously, right. For investors, we have a more global view, and
yes.
There isn't that same kind of limitation, certainly.
Yeah, we just have to be careful if it's a loan to someone. We're stewards of people's capital, and shady stuff's been known to happen, and we need to make sure that we are not a victim of that.
Yeah, so that's an interesting point there. So what are the type of investments you're looking at? You're buying secondaries, but you're also doing loans for employees that want to.
Yeah. That's the mechanism. When people have stock options and they're looking to exercise, I can't just buy somebody's contract. The only mechanism to really do that is really through some kind of forward contract, or, but effectively they end up being, most of the time, being non-recourse loans.
Yeah. Okay. And then it comes to an interesting crossover, because you are raising, and you're looking to raise from high net worth and family offices, and they may want to invest into the fund, but they also might have a portfolio of companies that they want to exit out of. So there's an interesting mix there.
Right. We have those. Oh, the other thing we should mention, it's important because this is in our deck, because one thing you worry about with a fund like this is something called idiosyncratic risk. There are some funds who do this. One of our competitors runs a much more concentrated strategy. Go with God. That's great if you choose well. It's really a disaster if you don't. So we're running a more diversified portfolio. And as a result, if we had a $150 million fund, the largest check we would ever write is $4.5 million. That's very different from venture, where if you had a $150 million fund, the biggest check you would write is 15. As a result, we'll end up with a lot of overage. For example, the company I was describing in abstract terms that we negotiated this 40% discount, we were dealing with a founder and a bunch of early employees. We had $15 million available. We would make that available, the more than 10 million available to our limited partners on a no fee, no carry basis. Here's all our diligence. You want to invest? That's available to you. So it's a way of, obviously, if you have a direct interest, you can do that. So you also get to open your deal flow in a way on, whatever. So that's been really attractive to large families and endowments that we're talking to.
that is very attractive because you doing all the due diligence and getting, negotiating a better offering is something appealing to large family offices to say, well, hold on, we can invest into this fund, but get, take the effort and the due diligence out of finding deal flow as well. So
yeah, absolutely.
That's a bonus. All right. Is there anything else that you think is important for our audience to know about your fund? Anything that you think will provide credibility or excitement about what you're doing? Because I know it's an interesting space, and there is a lot of demand there, but it is often put to the side because people are looking at VC and straight investment.
Tim?
Sure. So one thing I want to stress is just we believe the data science and machine learning funnel is an edge, and we're not aware of others in the secondary space that are doing it this deeply. On the other hand, this is not a black box or a fly-by-wire system where we're going to buy whatever the algorithm tells us to buy.
Yeah.
As we said, it's a funnel and a shopping list, so it's got to be married to all the human work of due diligence and analysis and connections that help us acquire the shares in the first place. So it's really a marriage of algorithms and data on the one side, and the long experience we have on the other, and they're both very key.
The best of both worlds that provides you your edge.
Right. Yep.
Okay.
Yeah, I think two other things that we should mention. We're only investing in sectors we understand: AI infrastructure. Tim's worked with data science. Tim was doing data science before they called it data science, actually. I've been working with AI companies for the last dozen years, and we both understand enterprise AI infrastructure, cybersecurity, fintech. That's our swim lane. We're not doing biotech. We're not doing things we don't understand. Also, healthcare IT is another sector I focus on. So that's one thing. And second, really important for investors, this is designed as a 7-year fund. So this isn't like, oh, it's a 10-year fund with 5 years worth of extensions. This is designed with a shorter fund life by design. And as I said, we can sell, our point is, if you end up with a company that's long in the tooth, we're happy to go call the company and say, do you want to buy your stock back, right? So, or sell to another secondary buyer. So there are better exits for this than a traditional fund, and by design, a shorter fund life. So it doesn't have the 10x potential, but has a higher IRR characteristic because you get the funds back earlier is actually the point of this kind of strategy.
Yeah, amazing. All right, guys, I'm not going to take too much more of your time. Thank you very much for jumping on. This has been it's been great. It's very informative. It is a different sector to your traditional VC, but it is a much needed sector, and there is a lot of opportunity. And using your edge, you can find really good deals that are overlooked, and you can negotiate a better value to the opportunity. So any investors, any family offices who are looking at not just the secondaries, but finding a vehicle for high quality deal flow that they can get into as well, this is something that's certainly of interest.
Yeah, absolutely. Thank you so much, Daniel. We really appreciate it.
We appreciate
Not a problem at all. Thank you very much for jumping on. It's been great to chat.
Pleasure's ours. Have a great evening.